So you've got some saving and you're looking at options of how you can invest that money that you've saved so that it can earn you a return, possibly can beat inflation. So far, I've looked at 2 investment options. I looked at starting a business, then I looked at investing in real estate. The third investment strategy I want to look at is investing on the stock market. Let's get started. Hello there, entrepreneurs, and welcome to another episode of Investing Facts with Mukonki Mukonkela, the host of the Ndalama Insights business show, where we turn your challenges into actionable insights. Today I've got a lot of actionable insights for you, and maybe even new terms that you need to be aware of. The first term I want you to know is the word issuer. Issuer refers to a legal entity or a company that develops, registers, and sells a security to finance its operations. There are different types of securities that a company can register. You might have heard of stocks. That is some kind of security that a company registers. There are many others, such as bonds and debentures. So it's very important to note that a company can register not just stocks, but also bonds and debentures and other securities. Now let's go back briefly and understand the stocks, because when it comes to the stock market, stocks are the most generally traded securities. So what is a stock? A stock simply refers to ownership of a company. It's a share of a company. When you invest your money by buying a stock in a company, it means that you are buying a share or a stake in that company. Now there are 2 types of stocks that I want you to be aware of. The first one, which you might know, is the common stock. There's also another one referred to as the preferred stock. So the common stock is a stock that gives you ownership to a company and also allows you to vote during the annual general meeting or AGM. You may also get dividends when the company declares a profit and decides to give out dividends to its shareholders. The other stock that you need to know is the preferred stock. A preferred stock gives an investor assured or first preference when it comes to dividend payments. And with a preferred stock, the investor has a scheduled payment of the dividends. They know when they are going to get the dividends, unlike the common stock. However, the preferred stock does not get voting rights, and the preferred stock is normally issued at a par value. The par value is a fixed value which does not change, and it is different from the stock's trading or share price. Because of this, the preferred shares have got limited growth potential compared to the common stock. A common stock has got unlimited growth potential because its value is tied into the share price or the trading price of that share on the stock market. The other feature of a preferred share is that it can be called back by the company at any time, even without notice. So the company could decide to buy back the preferred shares from the shareholders. And so it's very important that you know the differences between the common stock and the preferred shares. Investors that are risk averse normally would consider the preferred shares, especially if they are interested in the income or the assured income that they'll be getting regularly. So they would look at the preferred shares compared to the common shares. Preferred shares are rarely offered. Very few companies actually offer preferred shares. I'm not sure what companies in Zambia offer preferred shares. I'm going to do some kind of research when I give you a detailed video on how you can go about trading on the Lucid. So other than stocks, we've got bonds that you can trade on the stock market. A bond is a loan that is offered to a company. So an individual gives a loan to a company, and that is referred to as a bond. And it's a long-term security. As with any loan, the investor, the one that gives out the bond, gains interest as well as principal repayments. An important term to note with bonds is the maturity date. So you will get the principal lump sum payment on maturity. So that is what bonds are. They can also be traded on the stock market. Same as debentures. Debentures are also long-term loans that you can offer to a company. Now let's take a look at mutual funds or unit trusts. Unit trusts normally fall under the same category as mutual funds. These are investment companies that pool different finances from different investors or many investors and pool them into one unit trust. And then each unit trust is made up or comprised of small units. Investors buy a unit or a share of that investment fund. So the reason why people would consider unit trusts is because these unit trusts are managed by investment firms who are experienced in investing on the stock market. Now, when you buy a unit in the unit trust, you are pooling your money with other investors and giving an investment firm to invest that money on your behalf. That investment firm normally has a strategy of how they want to invest that money. So you need to research what that strategy is and if it matches your investment goal. An investment fund might decide to invest the pooled finances in stocks or in bonds or even in real estate, or a combination of stocks, bonds and real estate. So it's very important you understand what strategy this investment firm is taking, even when you're buying these units. And normally the unit trusts are offered as a one-time public offering, but you also need to find out if you can redeem. So when you buy a unit in a unit trust, you gain the rights to the income and capital appreciation that is made by that unit fund. Unit trusts are designed to be held for the life of that unit trust or fund, but you can redeem your shares in that unit trust by selling your shares in the unit trust. So when you are investing in unit trust, you need to really understand how long this unit trust is going to last or when it's going to expire, and match that with your investment goal. Where you find that the expiry date of this unit trust is far off, maybe 50 years from now, and you've achieved your investment goal and you'd like to redeem your shares, you need to find out if it's easy to do that with your current investment firm. So how easy is it for you to redeem your shares or sell your shares in the unit trust? So you need to find this out from the investment firm before you invest or choose a unit trust to invest in. So far I've looked at the securities that can be traded by companies that are seeking to finance their operations through the stock market. Now let's take a look at the actual stock market itself. When it comes to investing on the stock market, you need to be aware of two primary markets. The first one, which is the primary market, and then there is the secondary market. So you need to be aware of two general markets when it comes to trading on the stock market. So the primary market is the market where companies sell their shares to the public for the first time, or the issuer. Remember who the issuer is. That's the company trying to raise finance for its operations, sells its shares to the public for the first time. And normally this is referred to as an initial public offering. Very few people get to enjoy the benefits of investing in the primary market. It's either very big investment firms or banks or very big investors. Many of us invest in the secondary market. The secondary market is the stock exchange itself. So stock markets such as the Lusaka Stock Exchange, the Johannesburg Stock Exchange, the New York Stock Exchange, the London Stock Exchange, the Nasdaq, and so on. The secondary market allows trading of shares of companies among investors. So in the secondary market, you are not selling directly to the company. You are selling amongst investors. And that is the key difference between the primary market and the secondary market. And the stock market is where the trading amongst investors usually takes place. So now that we've gotten rid of some of the key terms when it comes to investing on the stock market, let's take a look at how investing on the stock market beats inflation. Because remember, we're trying to beat inflation. We want to make sure that our savings are not eroded by inflation, but rather gain value so that we can build wealth over the long term. In theory, investing on the stock market is meant to beat inflation because when there's an increase in the prices of goods and services, it normally translates to an increase in the production cost of the company. Many companies have an advantage of increasing the prices of the goods and services that they sell and thereby transferring the increase in their production costs to their consumers. This therefore means that their profits are kept intact or protected from the effects of inflation. So because the net profit is protected as a result of transferring the increases in inflation to consumers, we expect that your dividend yield is going to remain the same. Your dividend yield is simply the dividend divided by the share price of the share that you own. Because the company protects its profits by increasing the prices of its products, we expect that your dividend yield is also going to be protected. However, this might not be the case in practice. And so when it comes to investing on the stock market, you need to look at stocks that are inflation resistant or industries that are inflation resistant. But generally, the stock market tends to perform really well over the long term and normally beats inflation. When you are considering investing on the stock market as your investment option, you really need to look at it as a long-term investment strategy. Over the long term, investing on the stock market generally beats inflation, and there's a lot of research that has been done around this. One interesting aspect of investing on the stock market is the compound earnings that you can get. This is similar to the compound interest that you get from a bank. When you invest invest in the stock market with a long-term view, we expect that you are going to earn compound earnings. These compound earnings comes as a result of you keeping the shares in the company for a long term, so that when a company declares a dividend or the price of a share increases, you do not rush to selling that share, but you keep that share for as long as possible. As a result, you are going to earn what is referred to as compound earning, because you are going to get gain over gain. For example, if a stock investment gives you a dividend yield of 4% and the stock itself increased by 5%, but the price of the stock increased by 5%, you would have total earnings of 9% in that year. When these dividends and price gains compound over the long term, you then have what is referred to as compound earnings. Compound earnings is what has made most investors on the stock market wealthy. So the secret is to keep your investment in that company for as long as possible. That way you can get to earn gain over gain, which is the compound earnings. And expect that you can actually beat inflation over the long term. So when it comes to beating inflation, take a long-term view of investing on the stock market. However, something to take note is that stock markets generally tend to underperform in environments with high inflation. And Zambia, unfortunately, falls under that category. So you need to look at, investing in stock markets where the returns are higher than your inflation rate. So you've got some homework to do in that regard. You might have noted that I mentioned so many stock exchanges or markets where you can buy and sell your shares. I mentioned the Johannesburg Stock Exchange, the Lusaka Stock Exchange, there's the Nigerian stock market. So which stock market should you invest in? Well, the decision is really up to you. But the procedure in terms of how you go about trading on a stock market are similar. So let's look at the steps of how you get started investing on the stock market. You will not be allowed to directly trade on a stock market or a stock exchange. You will need to work through a stock broker. And so the first thing you need to do is to open an account with a stockbroker. And this is normally a very simple process. In Zambia, there's a simple form that stockbrokers have that you complete, and they normally open that account within a day or two, and you'll be ready to start trading on the Lusaka Stock Exchange. Once you have that brokerage account, it allows you to buy and sell shares of companies that are listed on that stock market. So this is the secondary market that I referred to in my introduction. Now, you can actively manage your own investment portfolio, or you can work through an investment firm or a broker to manage your investment on the stock market. Actively managing your own investment entails that you need to understand a lot about each company that you are interested in investing in. So you need to do a lot of quantitative and qualitative analysis of the company that you are interested in, so that you can keep an eye on the performance of that company and its share value. This also ties into the strategy that you'd have already devised in terms of how long you should hold on to that share, or when you should sell that share depending on how it's performing. So that is actively managing your investment portfolio. You can also have an investment firm manage your investment portfolio. And as a first-time investor, I encourage you to consider working through an investment firm, because it is their job. This is what they wake up to do every day. And so they are really experts in managing shares or managing investments on the stock market. So consider working through an investment firm, and possibly also consider starting your investment by investing in unit trusts, because unit trusts allow you to pool resources with other investors and then give an investment firm who will manage that investment for you, and they assure you of earning an income as well as capital appreciation in your unit share over the long term. When you start by investing through unit trusts, it allows you to start understanding what trading on the stock market is without taking a big risk of investing your money yourself directly on the stock market, because it can be a huge risk and many investors have lost out money by trading on the stock market. For you to start slowly, consider starting with unit trusts, because it's going to give you that confidence and knowledge of how the stock market works, so that the day you want to actively manage your own portfolio, you would have learned at a low risk of how to go about investing on the stock market. So the process is the same whether you are opening a brokerage account in Zambia or overseas. If you are trading overseas, you need to find a broker who's based overseas that can help you open that account so that you're able to trade in that country's stock market through that broker. So as I come to the conclusion of today's video, I would like to encourage you to look at investing on the stock market as a long-term strategy, because it will allow you to get compound earnings, and that way you're going to actually beat inflation, and you're going to gain income through dividends as well as capital appreciation in the value of your share. The next video that I look at is investing investing in government securities and bonds. I hope you enjoyed today's video. If you did, don't forget to like it and subscribe to my channel by clicking the subscribe button below. The next video, I take a look at how you can invest in government securities and bonds. Thank you so much for watching and see you next time.